I lost another 50,000 today. The A-shares market is driving me insane. Please stop dropping. If it keeps going down, I'm going bankrupt. This investor is feeling completely hopeless after suffering significant financial losses in the stock market and now faces the risk of bankruptcy. Y'all used to say just playing around could earn some pocket money. I've been doing this for 5 years, nearly 5 years now, and I don't even have enough money to buy underwear anymore. I'm drinking herbal medicine every day just to keep going. In the video, the woman finds herself in financial distress because of stock trading, struggling to even cover her basic living expenses. Honestly, I don't get it. Why do I keep playing with stocks? Why do I keep messing with this ridiculous game? I can't stop. What can I do? I talk about stocks every day with all my friends, and every conversation somehow ends up being about stocks. And I'm terrible at it. It's like I'm punishing myself. I haven't been around lately because I've been sick. This time, almost like I'm only half alive. First, it was illness, then stocks, and then Bitcoin. I haven't lost that much on Bitcoin yet, but today it dropped another 6 points. And my stocks, I'm down more than 6,000 today, and it's only 10 a.m. The more I talk about it, the more worked up I get. Nothing else gets me this emotional, only stocks. I think about it constantly, even in my dreams. Last night I dreamt that my account crashed to rock bottom and I woke up in a panic. I was awake by 6 a.m. and now my eyes are swollen. Lately the light has faded from my eyes. There's no energy. Something's wrong, really wrong. I feel off physically and mentally. I finished my antidepressants and my brain feels like it's going to explode. Trading stocks has become a part of her life, and it has brought her serious negative effects, including heavy financial losses, health problems, and emotional struggles. China's economic slowdown has led to continued declines in the Chinese stock market, and for many investors, these losses are creating immense pressure. Recent studies show that the sharp fluctuations in China's stock market are causing serious psychological distress for some investors, with a number of them requiring emergency treatment. How can any stock trader be mentally okay? Recently, I've lost so much that the pressure is unbearable. I've been dealing with insomnia. I'm barely eating, and I've lost so much weight in such a short time. I can't take it anymore. Today, I ended up in the hospital. I thought I'd just get a checkup and maybe some herbal medicine to balance things out, but it turned out to be way more serious, so I had to be admitted to the hospital. It's all because of stocks. You all know how bad the market's been lately. I've been bottling everything up inside, unable to vent. Even when I do try to vent a little, I can't really say much. The doctor asked me how I've been lately. I actually feel okay overall, it's just that I've been irritable, frustrated, and feeling helpless lately. So the doctor did some tests, and now they're saying I have explosive anger disorder combined with anxiety. I always thought I was calm and composed, but now that I've got this diagnosis, I feel like I've got permission to completely lose control. Since I'm officially sick, I'm just going to let loose and vent because otherwise I can't cope with this illness. The significant losses from stock trading have caused this woman severe stress and anxiety, resulting in physical symptoms like irritability, insomnia, loss of appetite, and rapid weight loss. In June, Nature Mental Health published a study showing that stress from stock market fluctuations can lead to both physical and mental health issues. They include cardiovascular disease and mental disorders, which have increased emergency room visits. The study looked at daily records from 3 large hospitals in Beijing between January 2009 and December 2012. It found that when market returns dropped by 1 percentage point, cases of cardiovascular disease rose by 0.19 percentage points, and mental health cases increased by 0.02 percentage points. Researchers estimate that a 10 percentage point drop in market returns could result in an additional 35 million yuan, or $4.9 million in emergency medical costs nationwide. The study also noted that these health impacts are immediate and uneven, affecting the elderly and men the most.
Every day trading stocks feels like walking into an execution. I'm done this time. No more showing off. My losses have exceeded 500,000. It's 520,000 now. Everyone keeps saying the A-shares market is undervalued, but I'm not seeing any value. Every time it's the same excuse. Oh, the Asia-Pacific region is collapsing. But has it ever actually gone up? It was 3,700 points in 2021, and now 3 years have passed. From 2015 until now, it's been 9 years. Has it ever risen? Give us a break and let it go up. You're right, it's garbage. Picking through this junk, how can we find anything good? I've lost money. On the last day of July, I managed to recover a few thousand. Otherwise, I wouldn't even have money for underwear. In May, June, and July combined, I lost 164,900 yuan. I'm not kidding. Watching other people lose money makes my heart ache. I finally learned what heartache truly means. I've already accepted that August is going to be all about losing money. No question about it. 3 trading days, 3 straight losses. Last Thursday, I lost 13,000. Friday, 15,000. Today, another 26,000. That's 56,900 gone in 3 days. My returns are now negative 2.65%. It's unbearable. I have to get out, walk around, get some fresh air, and just look at people to feel a bit better. Even though it's 36 or 37 degrees out here, I don't feel hot at all.
This investor's performance in the stock market has been poor, especially as the market continues to decline and losses mount. He is feeling deeply frustrated. In July 2015, the Chinese stock market experienced a major crash, leading to a surge in cases of what's called stock anxiety disorder. Some reports even suggest that university students have had to put their studies on hold, unable to break away from their investments, while others seek psychological counseling, overwhelmed by the severe financial losses. Though the data used in this study is more than a decade old, researchers are calling for new medical and financial data to be analyzed. Today, many Chinese investors are sharing their psychological struggles on social media. One user on Xiaohongshu shared that after losing over 1 million yuan trading stocks, she was diagnosed with depression. Others commented, sharing similar stories of feeling stress and pressure. It's over. I'm down another 12 points. I've been holding on since April 30th, and now it's July. Today I lost 12 points, and it's never gone up by 12 points. I'm going crazy. Y'all better hurry up and get to Shanghai. Hurry. This investor is feeling anxious and frustrated as the stocks she has held for several months have continued to drop, falling by 12 percentage points. I woke up today and lost 7 figures. Over 4,400 companies are down. I should have just stayed asleep. The woman mentioned losing a 7-figure sum, over 1 million yuan, a significant amount of money. She also referenced more than 4,400 companies falling, which points to a major downturn in the market, further deepening investors' struggles and heightening their uncertainty and disappointment. Between 2000 and 2022, the number of Chinese stock investors surged from 29 million to 320 million. As more people entered the market, stock market fluctuations had a larger impact on personal and family finances. In recent years, investor confidence has taken a hit due to factors such as the pandemic, difficulties in the tech sector, and a sluggish real estate market. Over the past 3 years, the CSI 300 index has reported losses. With the economic outlook uncertain, many families have cut back on travel and big-ticket purchases. On August 12, all 3 major indices of the A-shares market declined, with trading volumes falling below 500 billion yuan, hitting a new low since May 2022. Researchers have noted that illnesses less linked to psychological stress, like infections or parasitic diseases, are not significantly impacted by market fluctuations. They also suggest that digital health data gathered during the COVID-19 pandemic could be used for further studies to better understand how market volatility affects health. On August 14, all major A-share indices fell across the board, with the 3 main indices fluctuating throughout the day. By the end of the session, the Shanghai Composite Index was down 0.6%, closing at 2,850.7 points. The Shenzhen Component Index dropped 1.2%, ending at 8,311 points, and the Chi-Next Index fell 1.4%, closing at 1,584.3 points. Among industry sectors, more were down than up. The gaming, consumer electronics, telecom services, and cultural media sectors led the gains, while wind power, biopharmaceuticals, chemical fiber, aerospace, and energy metals were the worst performers. The Shanghai market saw a trading volume of 207.5 billion yuan, while the Shenzhen market recorded 270 billion yuan, bringing the combined total for the two exchanges to 477.5 billion yuan. Trading volumes remained below 500 billion yuan for the third day in a row. On August 12th, the combined trading volume across Shanghai and Shenzhen fell below 500 billion yuan, dropping to 495.9 billion yuan, the lowest level since May 2020. On August 13th, the volume shrank further to 477 billion yuan, marking the lowest point since December 2019. On August 14th, there was a slight recovery of just over 100 million yuan. Overall, more stocks fell than rose, with over 3,700 stocks declining across the market. Northbound funds, representing foreign capital, posted a net outflow of 7 billion yuan, with total transactions reaching 76 billion yuan, accounting for 16% of the A-shares market's total transactions. Some Chinese media analysts have suggested that recent outflows of foreign capital, along with liquidity pressures in August, have contributed to the subdued trading activity in the A-shares market. Senior investment advisor Zhu Hualei from Zhufeng Investment Advisors told Caixin Media that the market remains weak, with recent sentiment being quite low. Trading activity has been sluggish, reflecting a lack of confidence in the market. Not only that, rapid sector rotations and poor profit opportunities have also worsened the mood. The pullback in previously popular sectors has also led to capital outflows, further heightening a defensive atmosphere. Another senior investment advisor at Zhufeng, Yu Xiaoming, explained that the weakness in the A-shares market stems from multiple factors, including domestic investors' concerns over the economic outlook and uncertainty about policies. The ongoing low trading volumes show that investors are cautious, waiting for clear signals from the market or the government. Since 2020, A-shares have only seen daily trading volumes drop below 500 billion yuan on 3 occasions. In 2020, there were 4,074 listed companies on the A-shares market, but by 2024, that number had grown to 5,335. In this context, daily trading volumes of under 500 billion yuan mean that the average turnover per stock hasn't even reached 1 billion yuan. In other words, despite a 30% increase in listed companies, trading volumes have hit new lows. This indicates a sluggish investment environment and a shortage of liquidity. The stock market relies heavily on existing capital to operate, which suggests it may face further pressure. Wanlong Finance published an analysis on August 13, stating that the A-shares market has been hovering around 3,000 points for some time, largely due to imbalance between supply and demand. For over a decade, there has been an oversupply of stocks, resulting in downward pressure on market indices. In addition, Chinese investment institutions have noted that historically, when trading volumes shrink to extremely low levels, it can signal a market turning point. According to a related report by Finance World, since May of this year, the Shanghai Composite Index has broken through key support levels of 3,000, 2,900, and 2,800 points, repeatedly hitting new lows. The persistent low trading volume suggests that market panic has reached its peak, and most investors have chosen to sit on the sidelines. Analysts caution that while the Shanghai Composite Index appears near a bottom, it may not yet be at the historic bottom. Looking back to late 2018 and early 2019, the turnover rate for the Shanghai Composite was consistently below 0.4%, hitting a record low of 0.3% on December 11, 2018. This suggests the market could still have further to fall. In its latest report, UBS noted that stock holdings by the world's top 40 investors, both active and passive, in Chinese stocks have hit a 10-year low. Of the 824 active funds tracked by UBS, around 190 have completely eliminated their Chinese stock holdings, and 15 global funds sold all their Chinese stocks in the second quarter of this year. As of June 30th, UBS tracked 824 active funds with a combined of nearly $2.3 trillion in assets under management. Chinese stocks accounted for just 6.6% of their portfolios, down 2.4 percentage points from the benchmark index's 9%. The total value of their Chinese stock holdings was around $150 billion. With China's stock market on the decline, capital market company MSCI recently announced plans to continue removing Chinese stocks from its indices, further reducing China's share in key emerging market benchmarks. Bloomberg reported on August 13 that MSCI will remove 60 Chinese stocks this month, marking the largest cut in 2 years. Earlier, MSCI removed 66 Chinese stocks in February and 56 in May. These changes will take effect after the market closes on August 30th and will apply to all MSCI global indices. The removed stocks include Air China, Sany Heavy Equipment International, and Shanghai Foshan Pharmaceutical. MSCI stated that as of the end of July, China accounted for 22.3% of the emerging market index. Removing these stocks will put additional downward pressure on China's stock market, forcing funds that track these indices to sell off their Chinese holdings. For example, the iShares MSCI China ETF listed in the U.S. manages at least $7.9 billion and is part of the MSCI China Index. These adjustments by MSCI reflect the increasingly bleak outlook for China's economy. As a result, China's dominance in emerging market portfolios may be replaced by markets like India and Taiwan. Marvin Chen, a strategist with Bloomberg Intelligence in Hong Kong, said these removals are aimed at creating a fairer competitive environment for minority investors. He noted that China's previously dominant weight could now be more evenly distributed across other markets, such as India, South Korea, and Taiwan. As China's economy slows, global capital is gradually pulling out of the Chinese market. In contrast, MSCI plans to add 7 stocks to its India index. Reports suggest that India's weight in the MSCI Emerging Markets Index could soon approach that of China's. Independent research firms Smart Karma and IIFL Securities predict that after MSCI's adjustments, India's weight in the index could rise by at least 1 percentage point, bringing it closer to China's current 22.3% share. India's share currently stands at 20%. The increase in India's weighting could make it a new pillar of emerging markets, attracting more capital to the country. Bloomberg reported on August 12th that foreign investors pulled a record amount of funds out of China in the second quarter of this year, reflecting deep pessimism about China's economic outlook. On August 9th, China's State Administration of Foreign Exchange reported that foreign direct investment liabilities decreased by $14.8 billion in the second quarter, indicating a net outflow of foreign direct investment. This is only the second time this indicator has reached a negative figure since 1998. The report noted that if this trend continues, 2023 could mark the first year of net capital outflows since 1990, breaking a 33-year trend of growing foreign investment. Since peaking at $344 billion in 2021, foreign investment into China has dropped significantly. Slowing economic growth and rising geopolitical tensions have led many companies to reduce their investments in China. Meanwhile, China's rapid shift toward electric vehicles has caught foreign automakers off guard, forcing some to scale back their investments. Last year, foreign investment growth hit a record low. Despite this, the Chinese government is still trying to attract foreign companies by presenting an open stance, hoping they will bring advanced technology and help counter the pressure from the U.S. and other regions to decouple from China. The Financial Times recently reported that as China's economy weakens, British advertising giant WPP saw its sales in China drop by nearly a quarter year-on-year over the past 3 months. Porsche also reported a nearly one-third drop in sales in China for the first half of this year. Director of the First Institute of Economics at Tsinghua Institution for Economic Research in Taipei, Liu Mingjun, told VOA that one reason for foreign capital outflows is that the Chinese government is no longer encouraging infrastructure investment to stimulate the economy. At the same time, investments in electric vehicles and green energy, strongly promoted by the government, have fallen into inefficient competition. Liu noted that this kind of competition makes it difficult for foreign companies to adapt as they tend to follow international standards like protecting workers' rights and ensuring product quality, while Chinese companies engage in aggressive price wars. Additionally, with the ongoing U.S.-China tech war, a series of technology controls and supply chain shifts have further deterred foreign investment in China. Liu also pointed out that weak domestic investment and sluggish consumer demand have left China's economy increasingly reliant on state-owned funds and foreign trade. China's GDP growth rate fell below 5% in the second quarter, and if this trend continues, meeting the government's 5% growth target for the year will be challenging. OPEC has also expressed pessimism about China's economy, particularly in oil-dependent sectors like petrochemicals. French news outlet AFP reported that on August 12, OPEC slightly lowered its forecast for global oil demand growth in 2024 by 135,000 barrels per day, marking the first downward revision since July 2023. The report highlighted concerns about China's economic performance as the main reason for lowering the outlook for China's oil demand growth in 2024. Meanwhile, global demand remains strong at 2 million barrels per day. Voice of America reported that Chen Chengxing, a professor at the National Development and Mainland China Studies Institute of Chinese Culture University in Taipei, analyzed that China's difficulty in attracting foreign investment stems mainly from geopolitical factors and industry shifts. Chen Chengxing noted that despite the disappointing figures for foreign direct investment, there is still positive growth in new foreign direct investments, also known as greenfield investments. These investments are primarily focused on sectors strongly promoted by the Chinese government, such as electric vehicles, lithium batteries, and solar cells. However, even this category of investment saw growth slow in the second quarter of this year, indicating that foreign investors still view China's so-called new quality productivity as carrying significant risks. Meanwhile, countries like Brazil, Indonesia, and Malaysia have raised concerns about China dumping electric vehicles and new energy products and may raise tariffs, which could further dampen China's export outlook for the third quarter. With China's economic downturn persisting, scholars are worried that both domestic and international conditions could be affected. A professor of economics at Tunku Abdul Rahman University in Malaysia, Huang Jinrong, said that China's economic weakness is likely to accelerate the overseas expansion of large Chinese companies, with small medium-sized enterprises also following suit. He added that this trend could hurt smaller Southeast Asian businesses, leading to a backlash from countries that have traditionally been friendly toward China, potentially affecting China's regional political relationships. At the same time, economic weakness could increase pressure on ordinary Chinese citizens who cannot move abroad, making it easier to ignite social conflicts. China's economy is widely seen as struggling. Chinese official data shows that the added value of industrial enterprises nationwide grew by 5.1% year-on-year, down 0.2 percentage points from the previous month. Growth rates have now declined for 4 consecutive months. From January to July this year, fixed asset investment growth slowed, while real estate development investment fell by more than 10%. Nationwide, the sales area of newly built commercial housing dropped by 19% year-on-year, while sales revenue fell by nearly 25%. Domestic consumption in China is also weakening, with demand for big-ticket items like cars and jewelry slowing. The job market is deteriorating as well. Official data shows that the youth unemployment rate rose to 17% in July, the highest level this year, while the National Urban Survey unemployment rate climbed to 5.2%, which is a 4-month high. Critics have long accused the government of covering up the real numbers, suggesting the actual figures are much higher. Not only that, the urban unemployment rate does not account for the vast rural unemployed population. China Business Network cited multiple experts who observed that the strong supply and weak demand trend remained clear in July. This was primarily due to the ongoing adjustments in the real estate sector and weak internal economic growth, especially in consumer spending and private investment. A recent Wall Street Journal article titled "Fresh Data Shows China's Economy Stuck in Doldrums" pointed out that efforts by the Chinese Communist Party to resolve the real estate crisis and stimulate consumption have yet to produce results. This in turn leaves the economy in a tough spot. Following the Beidaihe conference, Chinese Premier Li Qiang reiterated the need to expand domestic demand at a state council meeting on August 16. He emphasized the importance of boosting economic recovery and stimulating consumption. Voice of America reported that Li Qiang's focus on expanding domestic demand and boosting consumption highlights the seriousness of China's consumption problem, which may be worse than previously understood. U.S.-based economist David Huang told Radio Free Asia that Li Qiang's meeting appeared to be an attempt to send a positive signal to the market, but concrete actions still need to be taken. Without improving foreign relations, economic measures alone may not be enough to resolve China's economic struggles. David Huang added that these issues cannot be solved by China's State Council policies alone, especially when it comes to foreign trade relations. Western countries' recognition of China is also a challenge. Commentator Li Linyi noted that Li Qiang's remarks lacked substance and were merely empty rhetoric. Even after China's third plenary session, reform efforts failed to gain market approval, and the stock market continued to decline, showing that confidence in the Chinese Communist Party is eroding. Li Qiang's efforts, he said, are in vain.